Give me 1 second. I gotta get the okay. Let's We're going now. So welcome everyone this morning. Great to be with all. It's always a good update that we have on the third Wednesday of the month. We want to thank all that are involved. The Cotton Board, the Texas Organ Producers Board, and the Corn Board for helping us put this together. So, with that, I'll turn it over to Dr. Anderson. Let him tell us what's going on in the livestock industry.
Well, great. It's great to be with you today. Thanks again for inviting me. Like always, I appreciate it. I think last month we were doing this. I think I called this high and rising, and now I just call it still high because we get some movement up and down. But man, we still have high prices, and in high price I'm talking about the cattle market, and that's where we'll focus our stuff today. I'm just going to hit some prices first, and then point out a little bit of stuff of what's helping boost these prices, I think, and then a little where we're going. I'm just going to start with fed cattle prices. A month ago when we talked, we were gosh, we were at 235 or 236 on the fed cattle market, and we backed off a little. And I've been asked a lot lately, God, my gosh, what's going on? Why have prices come down? Well, quite honestly, it's just a little normal kind of variation in prices from week to week that we see. And oftentimes when prices run up and peak like that, we get some backing off, and I think some of that's just related to filling some needs that were there. And then we back off a little bit, and you'll notice prices have headed back up. And if we look at the five market average, five market is higher than our Southern Plains, kind of Texas, Oklahoma prices, and again, it's pushing 240. And so again, very high prices. Yet, and the real reason is two things. One is folks are buying beef. The latest data on sales, retail sales at grocery stores, continue to show growth in the not only the beef case but the whole meat case, with not only our sales bigger, but the volume is bigger. It's not just higher prices driving this higher. And so, I see this kind of a little bit of up and down is really some of the kind of normal week to week variation in cattle prices. And that extends to the calf market with higher fed cattle prices. We've certainly got some higher calf prices as well. And in this case, I'm looking at 5 to 600 pound number one steers, kind of Southern Plains. We're back at $4, and just simply with fewer calves, some profitable conditions on the feedlot side, higher fed cattle prices, it's pulling prices higher. Now, I do think one of the interesting things is here we are. We're past the 1st of July now. We're almost to August. I think one of the things that I'm going to be interested in watching is, do we see in our local markets some real decline in the number of heifers that are brought for sale, really as an indicator of herd expansion. I think particularly with rainfall that we've seen, really driving a lot of pasture growth, some better range conditions, and typically, rainfall boosts calf prices. And so I think as we watch this going forward, does the ample supplies of grass uh, really boost our heifer retention numbers? We will see in another week a cattle on feed, or both a cattle on feed report and USDA's mid-year cattle inventory, which will give us the number of beef cows in the U.S., but also a notion of heifer retention for herd replacement. And so I think kind of looking forward to that. That report was not done last year due to some budget cuts. It's back this year, and I think it's something that all of us market analysts are looking forward to seeing when that comes out. So, but again, where we headed, because we're going to have prices higher than a year ago. But how high is really going to be determined by really the heifer retention side. Feeders are doing the same thing. Higher fed cattle prices, we've really pulled those feeder cattle higher. I think in this also we shouldn't forget about, I think, the effects of the border closure. In 2024, we got about 26,000 head a week of Mexican steers and spayed heifers that end up in our feedlots. And so the border closure continues to really constrain the number of feeder cattle and calves for sale. It's just further cutting into those supplies. And I should also point out those are typically lighter weight steers. They're not really in this 700 to 800 pound category normally. They're lighter weight. But again, tighter supplies driving those prices higher. And I thought I would also just keep on going with prices and think about the cutout for a little bit. We got pretty close to on some daily average cutout values to $4 a pound or $400 a hundredweight. The weekly average didn't quite get there, but again, this idea of kind of week to week variation. Uh, Really, if we think about how good beef demand has been, really, we get past, Memorial Day. Now we're past the 4th of July. We tend to see it's not unusual to see some lower prices or lower values on some of these cuts in this kind of long period of time from the 4th of July to Labor Day. We think about this holiday driven grilling season demand for beef and for other meats, but we get about 2 months here between 4th of July and Labor Day, and it usually gets pretty hot. And we're past some of that early grilling season buying, and we do get some slackening of price. It's not unusual to see that in terms of the cutout value. So that it's come down again, kind of week to week fluctuation. We probably had a lot of spot purchases driving the price up in the spot market, and now we see some backing off. I think that's pretty normal. Uh, I really want to focus more on the supply side about why are prices, uh, what's led to this strength in prices. And I want to start with steer slaughter. And really, you can look at that blue line. That blue line is 2025. And really, starting in April, we see a wide divergence between how many steers are going to market this year versus last year. And we've had some weeks since April where we've had as much as 7 or 8% fewer steers going to market than we did a year ago. So there's a real big supply component here in terms of steer slaughter, reduced beef production that's driving those prices higher when we think about it coupled with some really good beef demand. The other thing I would highlight is if you look at this steer slaughter, and that red line is a 5-year average. I think that's a decent way to look at it. The dotted line is 2024 on my chart. But that springtime period, we tend to have a little fewer numbers of steers going to market compared to the summer. And I think that's highlighted here as well, where we were about 275,000 head a week. And even over the last 4 weeks, we bumped that up closer to, 290,000. You see a little bit of seasonal increase in that steer slaughter. We're still well below a year ago, though, which is tightening up supplies and keeping prices high, but we're seasonally increasing a little bit. So as we think about, maybe some backing off in prices a little bit, this is how I think we ought to think about that going forward. There's a couple other interesting things going on. One of the things that's allowed us to keep beef production large in the face of fewer cattle is that we've been feeding animals for longer periods of time. Now, when Mark Welch talks about, feed consumption and everything, one of the things we've done by keeping cattle on feed longer is we're feeding them more. So that's boosted some feed demand. This is an interesting set of data from Kansas State University called Focus on Feedlots, and it's a little survey of some feedlots in Kansas. It's an interesting set of data, and what I've got here is I pulled the data for the average numbers of days on feed for steers, and This year, we're running significantly fewer days than a year ago. We were about 180 days in May for those closeouts in May versus almost 200 a year ago. So while we've had animals on feed longer, contributing to heavier weights, now I think we're starting to see some fewer days on feed because we've got fewer numbers of cattle and we got packers that need animals. I think that's pulling those numbers of days on feed down. Using that same set of data, I wanted to point out average daily gain, and we continue to see daily gains increasing compared to a year ago. So, if we feed them for fewer days, that's going to pull weights down. But if they gain more per day while they're on feed, that keeps weights up. So if we're going to make the transition thinking about from numbers of steers going to market to our amount of beef production, this days on feed, daily gains are pretty important in looking at beef production and weights. So as I look at weights, so far this year, we've trended lower and lower on weights throughout, the whole year. Now, the overall level is higher of dressed weights compared to a year ago, but the trend is lower. So as we send fewer animals to market and they're weighing a little bit less than they were early in the year, we're really starting to see some squeeze on beef production, particularly fed cattle beef production. And here we go with beef production. So I go from my numbers of steers sold times their weight gets us to beef production. Now, in this is also cull cows and heifers. I decided to focus on the steers for this, but week to week, really since April, some sharp declines in weekly beef production compared to a year ago. So why is our cutout hitting those kind of highs? Good demand that's continuing, and a lot tighter supplies of beef on the beef side. Excuse me. So really that becomes our story, is that, what's going on in the cattle market is just plain tighter supplies that are keeping the pressure on for higher prices. That extends to the calf market as well. And if I leave us with one other thought of where we're going with this, we've continued to shrink the cow herd. And I might say because, the check in hand for selling that animal has been worth more than we thought her productive life was going to be out there into the future. And with these kinds of calf prices hitting $400 a hundredweight, that check in hand, we got some pretty big checks. So the question is, will that continue to outweigh considerations of the future? So the check in hand today is worth more than what she's going to deliver us in the future. We're still in that balancing act for whether or not we begin to grow the herd. So, I think all this stuff kind of fits together pretty well. I think where we're headed is continued high cattle prices, high beef prices. And what we hope for is that the consumer continues to hang with us and continues to buy beef so that the demand side uh, keeps this tight supply side, and on balance, we end up with in higher prices. And I think that's where we're headed. That should be my last slide. See if I can get out of this and stop sharing. I think I got that done. So
Good information, Dr. Anderson.
I'm glad to go first because I can talk about high prices.
Yeah, we'll start off with a bang. No, appreciate you being on with us this morning. Good information. Cattle markets and stuff are very positive at the moment, and it's a good thing for agriculture at the moment. So anyway, so let's move on. Dr. Welch going to give us a grain perspective for us this morning, and I won't delay him and take off.
All right. Thank you, Bobby. Again, good to be with you all this morning. Appreciate this opportunity to share and talk about what's going on in the markets. Yeah, we got all that high price stuff out of the way. Let's talk about grains and cotton. I'm going to focus on the fundamental outlook and the drivers for grain prices. And what I want to talk about this morning is perhaps some divergence between what the fundamental picture would explain in terms of where we are with grain prices, relative to what we're seeing in the marketplace. And the two factors I'm going to focus on, the tariff and trade turmoil that continues to impact our many of our ag markets, and then expectations around yield, especially for the corn crop in the U.S. in 2025. And I think those are two particular features that are why we're seeing why the current grain price is not reflecting what are some pretty tight supply and demand fundamentals. We'll start with the balance sheet, and I apologize. The screen that I'm showing is including my the text as I'm speaking, and it's cutting off the top of my slides, so I don't know what I've done here. I'm going to shut this off and try one more time. Hang on just a second. Let's go back to share my screen. I want to share a window. Try this one more time. And it may be exactly the same thing. Looks like I'm right back where I was. So I want to feature the changes that USDA made to the corn supply and demand balance sheet in the July WASDE. In May is the first official estimates of what the corn supply and demand situation is going to look like, and for all of our major commodities. And then in June, as you'll see in the changes from the May report, look at all those zeros in here. So the June report showed virtually no changes from the first estimates in May, except an increase in use for the 24 crop lowered the carryover for the 25 crop. And then we get to July, now we have an acreage report that came out. USDA did lower planted acres by 100,000, but they lowered estimated harvested corn acres down by 600,000 acres. And leaving the corn yield unchanged at 181 bushels, that lowered the supply 115 million bushels. We increased use in the old crop year again, so 50 million bushels last month, 25 this month. So that lowered the supply for 140 million bushels for the 25 crop. Now, there was a slight downward adjustment in feed use, still really good numbers, following up with Dr. Anderson's comments around what's going on, particularly in the cattle industry. 5.85 billion bushels, that's still a lot of corn, but they trimmed that back a little bit. But our ending stocks dropped by 90 million bushels, our stocks to use ratio just below 11, and this days of use on hand, that carryover, how much grain's left at the end of the year from a 41-day carryover to a 39. Those are tight numbers. That's a relatively tight supply and demand situation, but our prices aren't budging with this relatively positive or bullish fundamentals. And so I'd like to explore maybe what's going on with that. And this just demonstrates that when you drop below that 40-day carryover, and again, we're at a 39 is the estimate right now for the 25 corn crop, we should be in this territory of $4.50, maybe pushing $5 corn when you drop that number below 40. And we're just not seeing it. And I think there's a couple of factors that explain that. First of all, is we've got a corn crop out there that's in excellent condition overall. We've got the good and excellent ratings for that crop have increased from the upper 60s, just getting better and better every week. Now we're at some 74% rated good and excellent. If you look at a crop condition index score created off these percentages, the blue dotted line would show what an average crop kind of looks like. And typically those condition ratings kind of drop a little bit through the year and then pick up as you get toward harvest season. And here early in July, we're just seeing those crop condition ratings just getting better and better. Now let's zoom in on that crop index. And the red line is this year's crop index rating. 385 is that index reading. Average would be about 368. The black dotted line indicates that average index as we were just looking at. The blue line here is last year's crop index. We had a 179 bushel yield. The green line down below, that was 2023 when we made 177 bushels. And the U.S. corn yield on average is growing about 2 bushels per acre per year. And so USDA tacking on, these were records, by the way. It was a record yield in 2023, a record yield in 2024, and we stuck another 2 bushels on there for 2025 and pushed it to a record 181. But with these kind of ratings, will 181 hold it? And that's kind of the question. And I think the trade is mulling over right now. If you just draw a straight line of corn yields, and I go back to 1950, you could start at 1980 You see that pretty commonly in corn yield analysis. Doesn't really make a lot of difference. You would project a corn yield just based on that straight line tendency of a yield in 2025. USDA's got 181. That number would point to 183.8. And I think given the crop condition ratings that we're seeing right now, that level of yield potential is not out of the realm of possibility. When I plug in USDA's current supply and demand numbers, planted acres, yield, use, all those factors, this is my corn price model. And you can kind of see how that model has performed in the biofuel era back since 2007. It's not perfect by any means, but it gives maybe a little guidance of kind of what you think prices ought to be. This is futures prices, by the way, not the season average farm price, the average of the October contract in the month of December. And it would point to a futures price of around $4.50 a bushel, not the current levels we're trading at right now. So what does that model look like? Here are the elements of that price model. Again, my planted acres, harvested acres, there's a yield of 181, production of 15.7 billion bushels, supply of 17 billion, use numbers right from USDA's balance sheet, days of use on hand, a 39-day carryover would point to a price of 456. The board closed yesterday at 420. I think there's something else going on in the market's mind that would not reflect what these fundamentals would suggest. And to adjust that balance sheet to get to a 420 corn price, plug in a yield of 183.8. That's the trend line yield that we were just talking about. So rather than USDA's 181, which is 2 bushels higher than a year ago, plug in that 183.8. Now we've got a production just under 16 billion, supply of 17.3, did not change my use numbers at all. Days of use on hand goes up to a 45-day carryover, not 39. Average, October average of the December contract, given that number, is 421. So it does seem to maybe verify that or add some information to the market's analysis of what's going on in the corn market, that they're not thinking that 181 bushels is going to hold, that the trade seems to be factoring in a yield something better than that to push prices down to where we are right now and at that 420 level. And typically where we are at this time of year, we've kind of got the acreage question settled. If we do see that yield look very positive, typically we would see prices then slide into late September, kind of a harvest time low at that point in time, early October. And so the question will be, if that's the yield, are we carving out a harvest low right now, or do we still have some bottom side left on this market if these crop conditions continue to be very favorable? That's on the supply side. On the demand side, we're still working under this pall of trade uncertainty and tariff implications on many of our ag markets. This is just a brief representation of that trade dispute with China, and it indicates the U.S. tariffs that we have placed on Chinese products, and then the response of China in placing reciprocal tariffs back on the U.S. February 1st, we put 10% tariff on all their goods. February 4th, they hit us back at 10%. March 3rd, we go to 20%. March 4th, they got another 10% on other products. Then we got to an era in which we're putting tariffs of 100%, 145%. They respond with 84, 125. Virtually these are trade embargoes. No trade is going to take place at tariff levels like this. In the current environment with China, we've backed off to about 30%. The latest numbers, and we're still in negotiations with China moving forward on this aspect. But then if you look at China's hitting back with us with about 10%, we're still impacting many of our ag markets. Then the development in the last week or so, are we looking at a new round of tariffs on a couple of other major trading partners with 30% tariffs on the European Union and Mexico? And if that does take place, likely to see some retaliatory tariffs from those countries on our products. So looking at our major grain trading partners and the export markets for our major commodities, I want to focus on how would this picture impact trade and ag commodities if you focus just on China, just on Mexico, and just on Europe. And that's what it looks like for corn, soybeans, rice, wheat, and grain sorghum. If you look at our major trading partners in soybeans, the top three are China, Europe, and Mexico. The top three with sorghum, China, Mexico, and Europe. Certainly, Mexico is the number one buyer of U.S. corn, the number one buyer of U.S. wheat, the number one buyer of U.S. rice. So, these factors are, I think, playing hanging over our market. We're already seeing them in the soybean and the sorghum market, with China virtually stepping out of buying any of those products at this point in the old marketing year. The question then being, how far will that carry over for our new price outlook and the price implications for this crop now that we're bringing to harvest, with grain harvest underway across much of Texas for sorghum and for corn. And then, of course, our wheat harvest is just wrapped up. The implications there, that's ahead of us. And so I think it certainly has some strong implications for what that could do to changes in the balance sheet if we start to see some difficulty in maintaining these export targets that are plugged into those numbers. So that's what I brought to share today. Be glad to take any comments or questions that you might have based on that. We do, of course, looking at high input costs. Hopefully the yield this year will compensate somewhat for these lower prices. The world balance sheet is still relatively tight. So the global carryover supplies. So if we do see a production problem anywhere, I think we could see a very quick reaction with some price volatility and a quick reaction on the upside to a production issue. But right now, the U.S. crop looks great. South American crops look great. Looks like we're going to have a record wheat harvest for this 25 crop year. So there aren't those supply issues right now, which puts downward pressure on prices. Weather is still a factor, but certainly this trade uncertainty, the global economy, and how these disruptions and disputes and how that all plays out into our price determination. So, Bobby, appreciate being here today, and turn it back over to you.
Thank you, Dr. Welch. Once again, really good information, and appreciate you being on with us this morning, and always good to have you on. So I guess now we'll turn to the cotton market outlook. Dr. Robinson, good to see you this morning, and appreciate you being on, and I'll turn it over to you.
Thank you, Bobby. Hopefully you can see my slides correctly.
Yes.
Okay.
We're good to go.
Well, it's a good thing that Mark preceded me, because he's made a lot of the points that are pertinent to the cotton market fit what he was talking about for grains, in terms of impact of the acreage report, in terms of impact on the July WASDE numbers, in terms of the trade impacts on demand, and in terms of good supplies for the 25 crop. All of that is pretty good story to explain what's going on with cotton futures. But I'll begin with putting up the supply and demand numbers from USDA. These on the right-hand side column is the July WASDE, the summary of which is that they're projecting that we're going to plant a little over 10 million acres and have somewhat average abandonment and a somewhat average yield. What these numbers don't show is before the June 30 acreage report, this acreage number here, 10.12 million now projected, was 9 point something. It was a lot lower, and the balance sheet was the balance sheet did some flip-flops, basically from a very high. I'm going to go down to the bottom, so sorry for jumping around. This number down here at the bottom in May and in June was 5.2 million. It was a much bigger ending stocks number. And then they came in and they cut it in the June WASDE, which is very unusual. They cut it down to 4.3. From 5.2 million to 4.3 million is a huge adjustment. They did it because of acreage adjustments and things like that, which would make this implication that comparing 4.6 million to the previous year's 4.1 is sort of a neutral change year over year. It was 4.3, sorry, to 4.1, sort of a neutral change nothing that should be interpreted as bearish. And that a month ago, and during the June WASDE, just when that report came out, I'm gonna cry over spilt milk. That report was the most bullish thing that's happened to the cotton market. That adjustment downward at ending stocks from 5.2 million to, at the time, 4.3 million. That should have been the trigger. That was probably our last chance at a bullish trigger, a bullish reaction in the market. And the market didn't react at all because I don't think the market believed it. So anyway, then we get an acreage report. We update the acreage and increase them. So that's adding to supply. That's adding to ending stocks. And so when the July WASDE came out, when these numbers came out, basically they're reflecting the higher acreage, the higher supply, and they bumped this up 300,000 bales. The sum total of my remarks about USDA's picture is that they raised ending stocks month over month compared to the June report, and so now we're going in we're going in the wrong direction. We're adding ending stocks month over month. It's an increase in ending stocks year over year, and it would have a bearish implication. And it's mainly, I look at this and say, we lost the only bullish opportunity we've had this year so far. We lost that opportunity, and the market remains range bound at a very low level. Part of USDA's reasoning for assuming a larger supply is the rains that we've had across many parts of Texas, but especially the northwestern, uh, all the rolling plains and the South Plains and the Panhandle and Kansas and Oklahoma. Those rains have been detrimental in other parts of the Cotton Belt, but USDA is assuming that the trade-off is a net benefit to U.S. supply, and they're going with that. Of course, this is Texas. We're always 3 weeks away from a blazing hot disaster. So who knows? Who knows how August will play out? There's still time for things to develop, but right now, USDA and a lot of the other cotton analysts that I follow are assuming that we're going to have, above average production, above average yields, below average abandonment, and we'll probably come in on the high side of production that USDA is forecasting. And that being the case, that is going to keep the balance sheet heavy. So we'll have to watch how that plays out. Other things that USDA is apparently assuming and the market is assuming is that, whether we go into a recession or not, or whether we have to worry about stagflation or not, at a very minimum, economic growth going forward is projected weak. That's reflected on this chart by this sideways dotted line, which is tracking world GDP. It's projected weak, and as GDP goes, consumption of cotton, which is this blue line, varies too. The blue line is pounds of cotton per person per year in the world, and it goes up and down with the economy, basically. And if we're projecting flat economic growth, then that's not anything that's going to pull up on cotton demand. And I think USDA is looking at this and assuming this, and so are the speculators, and so is the market. So as a result, we remain range bound. Like I say, we had the opportunity to bust out of this price sideways narrow range. Bust out to the high side was back in June, and that's the best that we did. And we're still sideways, and I don't really see anything that'll bust us out of this except for maybe a very big downward revision in certified acres, maybe in August. We'll get a certified acres report, the first of several. If that was surprisingly low, and if USDA, came into their balance sheet and cut out a bunch of acres and cut out 2 million bales, well, that would tighten up the picture, and we might get a bullish reaction out of that. But right now, the market is signifying weakness, and the speculators are signifying weakness. That's this indicated by this green downward pointing area represents people that are selling the market. A lot of people have sold a lot of cotton futures, making a bet that the market's going to go down from here. That's why they're holding that position. But they're reflecting the increased supply and weak demand fundamentals that characterize the cotton market, and as Mark said, characterize the grain markets too. So the last thing that's working against us is seasonality, which Mark also talked about for corn. This is the seasonal index between 0 and 1. It's the low and the high for the market on average for the December futures. Generally, there's a downset in June and July that's related to the market getting the acreage number pegged. And so we're past that point. So now seasonal influences are sort of working against us, where we're entering the period of seasonal lows. So, I'll just back up to here. I don't really see what busts us out of here. We might, if something really bullish were to happen, we might get over 70 cents. We might get to 72 or something like that. I don't see that very much upside, and there's probably a downside to about the mid 60s. So Bobby, I'll leave it at that. Appreciate you having me.
Again, thank you, Dr. Welch, Dr. Robinson, for being on with us this morning, and appreciate the information. It's all good, and sometimes we don't like it, but we need to know it. So thank you, and appreciate you being on. Right quick, I'm going to plug the beef cattle short course coming up in August. So if anybody has been kind of on the fence about going, I'd encourage you to go ahead and get registered. And it's a really good 3 days of beef cattle information, and I enjoy being there and going. So just going to give a plug for the beef cattle short course. Now we have Christy Short, who is the regional communications manager for the Cotton Board, and we're always glad to have her on. She brings us some good stuff about what's going on with the Cotton Board, and I'll turn it over to Christy at this time.
Thanks, Bobby, and thank you guys for having me on. Let me pull up my screen here. All right, you can see that?
Yes, we can.
Perfect. Okay, well, I'm going to give you guys a little bit of a different kind of update than what I've done before. We have, I think, some very exciting news at the Research and Promotion Program that has kind of evolved over this year. So when I talk about the Research and Promotion Program today, I'm going to be giving an update really on a lot of the activities that we're going to see coming out of Cotton Incorporated, which is one of the organizations that forms the trio of the Research and Promotion Program. At the Cotton Board, we collect that assessment and communicate to stakeholders. Cotton Incorporated really carries out the research and marketing of the program, really creating that demand and profitability. When I was on the call with you guys at the beginning of this year, we kind of talked about some focus areas that we were going on for 2025. These were the areas that were approved last year. So we always kind of look ahead in the second half of the year, approving activities and priority areas for 2025. And one of those areas that we were focusing on was evaluating the program. So I mentioned that we were going to enter into a third-party evaluation that was kind of taking place throughout the end of 2024, the beginning of 2025. And we have some results and some activities and kind of some shifts that I'm going to share with you today. So this evaluation project really started last summer. So in the summer of 2024, the boards of Cotton Incorporated and the Cotton Board were meeting through board meetings or meeting through officer teams, and really determined that this is something that we needed to kind of start in now. They did contract with a third-party evaluation company, and really the kind of priorities of this evaluation was to make a higher impact, more of an impact on cotton demand, and really decrease that cost of production. So increasing producer profitability, which those two things are really at the core mission of Cotton Incorporated and the Research and Promotion Program. One of the areas that I think is really important for you guys to understand as our stakeholders is kind of why we decided to do this now. I mean, it is of no surprise to anybody on this call or anybody listening in that times are tough and have been really tough on the farm. The economic climate, some market reports, as you've heard, it's just really challenging. Input prices continue to skyrocket. But the markets are just quite volatile and quite unpredictable. This has really been a challenge for farmers, no matter the commodity they've been growing, but particularly cotton farmers for a couple of years. We've seen a couple of different things in addition to that challenging producer economy. The threat from synthetic fibers has continued to grow and continue to increase. Fast fashion, cheap fashion, consumer prices, having a little bit more of a critical eye. We've had some interesting international trade dynamics, some different competitors come into the market as maybe China has backed out just a little bit, and even an oversupply of the market. And so these things have really made a variety of different ways that our organizations have said this is critical. This is kind of a tipping point. Producer profitability is at a low. Our cotton demand, our market share is really quite a low. What can we do to really change the game here in this environment? And so what our organizations did, they contracted with this third party. They went over tons and tons of files, interviews with staff at Cotton Incorporated, Cotton board members, producers and importers, partner organizations, etc. And this evaluation really took place from the end of 2024 into the first quarter of 2025. And so the information I'm going to share with you here in the kind of what's changing, what we found, if you will, in this evaluation is information that was shared with the board members, the officers and the board members in this first half of 2025. I'll kind of get into a timeline and when you can kind of see some of these changes come through a little later in this slide deck, but I think it's important to talk through some of these changes. It was really important in the evaluation to analyze what are some things that Cotton Incorporated is doing extremely well, and let's really kind of focus on those. And maybe what are some areas that we have an opportunity to maybe make a bigger impact, and how we can shift our body of work in those particular areas. So there's kind of 4 key areas of change that came out of this evaluation. I'll talk about all of these a little bit more in depth, but I'm really excited about these key areas of change. Some of these Cotton Incorporated is already doing and doing really well, and we're just going to put a little bit more emphasis on it. But one of the areas that I think is going to be one of the biggest changes we see that is really quite exciting is kind of a new marketing focus. So historically, our marketing focus has been really heavily on consumer marketing, and we're really going to shift that into kind of more supply chain marketing, so ingredient marketing. So think of this as marketing to the people at brands and retailers that are making the decision to put cotton in their products. So this really, in turn, is going to help those brands and retailers choose cotton, whether it's in home textiles, whether it's in fashion, whether it's in nonwovens, but getting cotton in those products on the shelf so consumers ultimately can purchase cotton at the point of purchase. A lot of our consumer marketing and kind of facing marketing is also going to highlight cotton's natural benefits. Now, this is something that we've been doing for years. We have an excellent sustainability department, but really putting a little bit more of an emphasis on the high quality, the sustainability. Cotton is a compliant fiber. All of those advantages really highlight that, I think, in this consumer space. That message is extremely important as we move forward into the next couple of years. We're also going to focus on some targeted brand partnerships. So instead of just kind of broad awareness, get some targeted brand partnerships that are really going to resonate with that message of cotton and with some key consumer audiences. And finally, we're really going to focus on some impact of key performance indicators, so keep KPIs in our research methods. So whether it's ag research, whether it's research on new technologies, maybe creating some new spinning techniques or something, we're going to adopt what we call fail fast approach. to this project funding. So if something is working really well, maybe we see some interest in adopting this technology, continue moving forward with that project. Maybe if we don't see interest, maybe if it's an ag research project that really isn't moving the needle on producer profitability, we can walk away from it, have a more able approach to walk away, to fail fast, if you will, from those research projects. So as we kind of move into a little bit more detail on these, so I've mentioned this new marketing focus. You can see here on the screen what I mean when I say this middle area, the ingredient, if you will. So we've at Cotton Incorporated always have marketed to brands and retailers, just not in the capacity that we're going to look at here, but really kind of focus on those brands and retailers, those decision makers that are putting cotton in products. That midstream value supply chain is really going to be our focus of marketing. As we all know, if a consumer prefers to buy cotton, but cotton is not on the store shelf, they can't buy it. And so this is really going to help kind of drive home that message of here's cotton on the shelf. I thought it was really interesting in this process that the third party company spent a lot of time talking with us of our how we can really make a big impact. And here on this screen, you can see Cotton Incorporated at the very bottom of the screen. It is a producer and importer funded program. And so we do, have a pretty limited budget if you think about it that way. And what we have spent in marketing if over the last couple of years has been about $33 million, which sounds like a great amount of money. You really make a high impact with that. But when you look at these other brands and retailers and the amount of money they spend in marketing to their consumers, it's quite astonishing. So for example, Levi's, who is a cotton heavy brand, right, in denim, the amount of money that they spend in marketing to their consumers is $433 million. Gap, another cotton heavy brand, $882 million. And so that really kind of gives you a perspective of the amount of money that we can spend marketing to consumers really isn't even a drop in the bucket compared to some of these companies. However, we might not have that budget spend, but marketing to those ingredient based individuals is really going to help leverage these funds in their consumer marketing campaigns, right? We can help them choose cotton and then leverage their marketing funds to encourage their consumers to buy cotton. This new marketing focus, I think it's really important to share. We'll definitely see a merge of our two departments, consumer marketing and global supply chain marketing. They'll merge together. Their teams are currently working together to create some new strategy, some kind of overall focus areas. But consumer marketing is not going away. I mentioned that we'll have those targeted brand partnerships. That's out of our consumer marketing department. They also are really integral in the industry in providing behavior driving campaigns. They also are really going to focus a lot of their consumer messaging on highlighting cotton's natural benefits. One of the messages that's been really popular and really successful over the last several years is the check the tag campaign, encouraging consumers to really check the tag in the clothing that they're buying. But this kind of natural benefit message is also going to promote cotton, high quality, sustainable. We have, again, like I mentioned, a really excellent sustainability department that is known across the industry as experts in their field, really using their research and their marketing to share those cotton benefits. It's been interesting over the last few years to kind of watch awareness and scrutiny of the microplastic issue with synthetic fabrics. I think these numbers are quite interesting that we've learned in this evaluation. Several years ago, in 2017, about 27% of consumers were aware of microplastics and that they were concerned about microplastics. This year, that number has gone up to 45%. Just that increase alone in the awareness of consumers, I think, shows how this issue on microplastics, synthetic fibers, and that fiber pollution, it's not going away. It's just increasing. And this is just really a great way, again, to show why it's so important that we continue to message cotton's natural benefits. In the microplastic space, we're talking about cotton fibers, their degradation, the polyester fibers and their degradation. And cotton really has a unique position. We can win on comfort, we can win on style, we also can win on health and responsibility in areas that are becoming of real concern to consumers. So finally, this kind of fail fast approach I've mentioned a little bit already, but it lets us really focus on allocating our resources appropriately and shifting them quickly if we really need to do that. So focusing on these key performance indicators, however they look in the different departments, that's going to look a little different on ag research projects as it will then in product development and implementation products. But having that mindset to say, how is this being successful? Or maybe this is something we need to walk away from. And these different departments, they're working through this now, how that looks in their department and what those key KPIs are and how their fail fast mindset is going to allow them to reallocate funds and resources to make a bigger impact on the demand and the profitability of cotton. So that's kind of a brief overview of some of the findings we have found. Hopefully it's encouraging and energizing to you what this new strategy and shift is going to look like. So like I mentioned, this evaluation really took place through the end of the year, through the first quarter of 2025. The Evolve strategy was presented to the Cotton Board of Directors as kind of the first step in our board meeting process. In June, it was presented to Cotton Incorporated with some real division level strategy updates with some kind of preliminary ideas of how they will implement this going forward. The boards and the officer teams have met, have discussed, and staff at Cotton Incorporated is currently kind of diving a little deeper in how these activities are going to look in 2026. Coming up in just a couple of weeks at our August 2025 Board of Directors meeting, it's a joint meeting between the Cotton Board and Cotton Incorporated. Cotton Incorporated staff will present the complete 2026 plan and budget. And that will include how they will implement this new strategy, what their areas of work are going to look like, including what their budget numbers are going to be. The Cotton Board approves, recommends, and kind of oversees that plan and budget at this meeting in August. So I expect following this meeting, the last quarter of 2025, we're going to have a lot more exciting, concrete information, a lot of new activities to share following this meeting in August 2025. And then it's important to note that the activities that are presented in 2025 will start taking place in 2026. So it's kind of a look forward, if you will. They'll use the rest of the year to finish out the plan of work that they're currently under. And then in 2026, we will start seeing the new programs, new projects that reflect that new strategy. So again, towards the end of this year, I hope to have a lot more detailed information and some really exciting new activities. It's also really important, I think, to remind you guys who your board members are in Texas. So I've shared on the Cotton Board just the members that represent South Texas. We have several other members that represent the Panhandle, the South Plains, Rolling Plains, Southern Rolling Plains, etc. But Michael and Miranda are the two members on the Cotton Board that represent you guys in the South Texas Coastal Bend area. We're fortunate to have their leadership on the Cotton Board, but I think it's important to share this with you. I'm also going to bring up a slide of the complete list of Cotton Incorporated Texas members. Hopefully you recognize your South Texas ones here. Marvin Beyer, who's a grower in Taft, Texas, is the current chair of Cotton Incorporated. So y'all really have great representation and great leadership in South Texas. But I think this is important to note, is they're really your voice on the boards. They're the ones asking questions to the staff. They're representing you at the board of directors meetings. And I'd really encourage you to reach out to these board of directors if you have some comments that you want to be heard at the board of directors meeting, some concerns. They're really your lifeline, as well as me. Of course, I'd love to visit with you, answer any questions, but your board members are, the elected representatives on your behalf. And I think it's important to make sure you know who's representing you. We're really lucky with the leadership that we have on both boards, especially in Texas. I think we have some great representation. Finally, the last two things I want to mention, I'd be remiss if I didn't talk about our producer tour program. We've completed an excellent tour season in 2025. We will have 3 tour opportunities in 2026, February and March for men and women to attend, and then our women's tour in June. And I think these tours are going to be really exciting in 2026 because you'll get to visit Cotton Incorporated and really hear firsthand of their new division approach and the new activities that they're doing. So we're really looking forward to these tours in 2026. I'd love to have anybody from your office or your operation that hasn't attended one of these in the past. We cover the travel expenses, and I'd be happy to coordinate any information that you might need on that. And finally, our Cotton and Coffee series has continued to be a success. The third Tuesday of every month. So yesterday is when we had our Cotton and Coffee this month, I'm sorry. But what I think will be great for you, if you haven't before, the one in August will come straight out of our August board meeting, and William Kimbrell, the Cotton Incorporated CEO, will present what came out of that meeting. Cotton Incorporated's vision for the future. He'll give the plan and budget that was approved at the meeting. And it'll really highlight that strategic direction shift that we've talked about. So it'll really be a great Cotton and Coffee to kind of learn more about what I've talked today and how we're moving forward. Again, hot off the press from our August Board of Directors meeting. If you have not attended a Cotton and Coffee before, shoot me a text or shoot me an email and I'll get you registered. If you have attended one, you'll receive the link just a couple of days to join. So hopefully you'll consider joining us for that to learn a little bit more about what I talked about today, the new vision and new strategy for Cotton Incorporated in 2026. Thank you again for having me on this call. I really appreciate it. And I will stop sharing my screen.
Great, Christy. I really appreciate you sharing that information. That's a good deal. It's always it's a shame that more of the public doesn't understand and see the relationship between production, agriculture, and all that surrounds it. So and helps market it and get those products out to the consumer. But we really appreciate you being on this morning with us, and I know it's always early, but appreciate it to all who, Dr. Welch, Dr. Anderson, Dr. Robinson, Christy, thanks a lot. And y'all, any of y'all have any comments or for us before we leave? All right. Well, I guess we will wrap this up. Thank y'all again for being with us. Have a great
Thank y'all
day.
very much.
Thanks.
Thank you, Bobby.
Bye-bye.
Y'all take care.